Good afternoon and hello. Welcome to this month's webcast, Tackling Nonprofit Board Accounting Myths. Today's webcast is brought to you by 501c Agencies Trust. 501c Agencies Trust is the nation's oldest unemployment program. If you're a 501c3 with more than 15 full-time employees, it would be to your benefit to contact 501c Agencies Trust to see how much money they can help you save on your unemployment expenses. Many of you on today's webcast are already working with 501c Agencies Trust. We thank you for that relationship. I'll go through a little bit of housekeeping here before we get started. Please feel free to submit any questions at any time as we go. We will address those as we go, and we will also address them at the end if we have a buildup of questions, which can happen. You can submit your questions in the lower left-hand corner of your screen below my photo. And those will be submitted to us. This session is also available on demand, so after you watch it today, if you want to watch it again or pass it to a colleague or a friend and you think they should watch it, you can just forward them the link and it will be live as soon as we're done today. A copy of the slides is also available. If you see below my photo, it says Event Resources. It's kind of a little drop-down button there. If you hit that little drop-down button, there's a PDF of the slides. We do these webcasts once a month, open to anybody and everybody who wants to attend. If you have any ideas for any webcast subject matter you would like us to cover, please feel free to shoot me an email, and I'll be glad to try to help you out with that. With no other housekeeping duties here, I'm going to go ahead and introduce our panel. How is everybody today?
Great, thank you.
Fabulous, yeah. Thanks, Mac.
Yeah, they all had to unmute their phones after I told them to mute them before we started. We'll start with Jeff Russell. He's the founder and CEO of Jitasa Group. They provide accounting services and software solutions designed to serve any nonprofit in any of the nonprofit subsectors. Also on the call this morning is Alan Lesher. He is a CFO of the YMCA of the Inland Northwest in Spokane, Washington, where he's responsible for all financial systems, information technology, and risk management. Also on the call this morning is Peter Gringan, is the CFO of the United Way of Pierce County, and he's served there for over 28 years, and he has complete control over the financial oversight of that United Way. So without any further ado, we'll get straight into our board accounting myths this morning, and we're going to start with Jeff. Many people believe internal controls create needless hassles. Jeff, how true is that, and how can controls be streamlined?
Yeah, thanks, Mac. You know, the trick with controls and internal controls, even if they do create hassle, to me it's sort of like insurance. When you need it and you don't have it, it's too late. Right, and so it's a necessary reality of any disciplined organization. That said, there are a number of things you can do to streamline it. So we work with literally nonprofits in almost every state, and we had a group of clients that it was mandated that they get 2 signatures on every single check that goes out the door. We can talk about that separately. I think that's overkill, but that was kind of their nationally mandated policy. So they had executive directors who would get whose signature, and the other signature had to be a volunteer, so it had to be a board member or somebody else. And so they were literally driving around town once a week with a stack of checks getting a second signature. And that is a huge hassle. And I would say that was a needless hassle. And so what we've been able to do working with them is we've actually automated the entire process now electronically. So the checks and the invoice come in, it's routed electronically through, there's a number of systems out there now that do electronic signatures that are legally binding, where the check comes through, the invoice comes through, the executive director signs it, an email automatically gets routed to the volunteer, they're on their smartphone, they sit there, they review it, they click approved, and then the checks get cut, and it satisfies the control requirement because you have 2 people looking at it. And in fact, the auditors like it even better because you know exactly who signed it, and you know exactly the time and date in which they signed it, and they can match that back to the, to the actual paperwork for the audit. So it's something that it's actually improved the controls, but it's taken a process that used to be, literally hours down to a few seconds. And there's so many apps out there now around AP processing. Mineral Tree is a really good one that actually automates, bill pay is a good one. There's a number of pretty inexpensive, small apps and gadgets that can really help improve internal controls. Fundamentally, the last thing I'll say, I think one of the single best controls you can have is really around the bank reconciliation process and ensuring that the people handling the money aren't doing the bank rec. And so I know there's probably nonprofits of all shapes and sizes on here, from budgets of $100,000 to $10 million, and that's a single control. You may be a 1, 2, 3 person organization, but that is a control I think that's really fundamental and is probably your most important one.
Jeff, we did get one question about the example you gave about them wandering around town looking for someone to sign. Are they signing a check, or are they signing a document to approve another document, to generate another document?
Yeah, no, good question. So what they were doing previously is they were actually signing the check. So they actually had 2 signatures on the check. What we've switched it to is we have 2 signatures on an electronic approval, and then the checks actually go out electronically. So we kind of moved it upstream to where we got the 2 signatures actually like on the invoice, if you will. It's actually a cover sheet of the invoice. But then the actual check and how that goes out is really, at that point it doesn't matter once you've got the approval. The control should be more around the approval.
Gotcha. All right. Well done. Okay. Next we'll go to Pete. Pete, we found this board myth. Most board members don't have a challenging understanding of financial information. They don't understand it. How do you report financial information to your board so that they all understand it?
Yeah, so good question, Mac. Well, as we all know, boards have a fiduciary responsibility to oversee the finances of our organizations. And I think, especially for our nonprofit, it's always a challenge to find, board members who know about financial statements, and especially the nonprofit world of accounting can sometimes be pretty mysterious. So it's been my role to, as a financial leader, to think of ways that I can present that information so that they do understand it. So I think one of the things I do is I work, with my finance volunteers to determine and agree on what are some key indicators that measure the financial health of our organization. And sometimes we come up with new ones, but over the years they pretty much, we're always looking at, say, for instance, like how are collections on our pledges doing? We're looking at how is our revenue matching up with our budget. We're looking at our unrestricted reserves and how that's going. We're looking at key indicators such as our endowment. Is our endowment growing? Are we also reviewing our policies, our finance policies, on a regular basis? So just some key indicators that you can present to your board. And what I do is I actually went to this seminar. It was called Boards on Fire, and I wish I could remember who put it on. This was probably about 5 years ago. And they said, to kind of spice up your finance report, especially with your non-financial people, they used emoticons. So I started using these smiley and frowny faces, and it actually was a big hit. And what I like about that, it's on the screen now, what I like about that is a lot of the non-financial people started coming up to me and saying, wow, this is really cool. I can actually tell by, the number of smiley faces up there that it looks like things are going pretty well. And then in addition to that, I don't think we have this slide today, I have what's called on the radar. So these are issues that are coming up, or that actually we should really pay particular attention to. So, for instance, we run a 211 helpline, and we depend on a lot of federal grants. Well, some of those federal grants have a good chance of going away this next time. So I have that on the radar, where we're actually asking our board to help us. How can you think of other opportunities for grants or other ways that we can replace that money if we don't get that grant? So that's just an example of something on the radar. Then probably one of the favorite things I do every year during the budget process, I create a narrative and I put in there a lot of graphs. And then what I do is I take that budget home to my wife, and she's a non-financial person, and I have her read that budget through. And if there's parts that she doesn't understand, I will explain it to her until she understands it, and then I'll go back to that narrative, and I'll incorporate that into the narrative. And again, board members will come up to me, and because I'll ask them, I'll say, hey, did everybody read? Did everybody understand? And I always get, in the last 5 years, I've gotten really good compliments from taking that approach and taking, time to talk with the non-financial people, and making sure that they really understand the financial information. Because I think it's really important. Every board member is responsible for the financial oversight of the organization. And it's important that every board member understands financially, at least the key indicators that can show your financial health. Very, very important.
Outstanding. Great. Thank you so much, Pete.
Yep.
Next one's for Alan. Alan, we have this myth that accounting is an exact science. Can you address perhaps the smokes and mirrors of accounting, and how it's not an exact, how it may not be an exact science sometimes?
Sure, Mac. Well, and in some cases, the accounting is a bit of an exact science. Debits are debits, credits are credits. A lot of the nonprofits, we fall under certain reporting formats. We have our statements of financial position, our activities and cash flows. Some of us do statements of functional expenses, and those tend to look relatively the same anytime we do them. There's some small formatting changes. But then at that point in time, things change, because a lot of times we're required to make some form of estimate. And that's where it becomes an art as much as a science, because the estimates are constantly changing. And that's where it becomes, there's no exact even. And I think in those cases, it's important that we're continuing to notify our governing board, our volunteers, when these material changes are occurring, so they understand what's going on. I think, and that's where it gets a little tricky, because sometimes a series of estimates are involved. We were involved in a $40 million capital campaign and building project some time ago, and we had a partner, another nonprofit here in Spokane. The campaign was in full force. Donations were flowing in. We started construction. Then as the building continued, we started having cost overruns that were contrary to our estimates. The market began to change, so our donation flow changed. It was becoming difficult to collect those donations. Then we had the sale of an existing building was built into that. The market changed, the real estate market changed. So all of a sudden we realized less money there, and this basically was quickly turning into what was starting to be an underfunded, over-budget project, which I think a lot of us have had. And so it took a lot of careful planning and a lot of communication in that case with our governing board and our management to explain to them what was going on every step of the way. Transparency became very important. At the end of the day, with these estimates and the not so much exact, we know these estimates will change, and it's important that we recognize these situations, analyze the extent of the effect of those, and that we're transparent with our board and our finance committees and our auditors as well.
Outstanding. Great. Thank you. And I remind everybody, just keep your questions coming. We'll address those as we go, and if we have some leftovers, we'll get to them at the end, or if they're off topic a little bit. Next myth for Jeff. Many people are proud when they get a clean audit and feel that should be the ultimate sign of success.
So first I would say a clean audit is better than a disastrous audit. So this is only partially a myth. And, we go through, the reason I think this is fundamentally a myth is there's multiple reasons you can have a clean audit. One of which, the good side is, hey, you're running a disciplined organization, you've got your ducks in a row, you've got your documents organized, you've got good controls in place, you're financially running a tight ship. So that's generally true if you get a good audit. So generally, definitely applies. For our clients, we go through about 500 audits a year. And what we find, unfortunately, is there's massive variance in the quality of the audit and the quality of the auditors. And so auditors are, humans like the rest of us. They screw things up. Some people are better at it, their jobs, than others. And so we had a client once who got a clean audit. The accountants are all kind of high-fiving. And he goes, and I thought this was really insightful. He said, actually it makes me nervous because surely we're not doing something right. So if I've got a clean audit, I can't improve. I didn't learn anything from the audit process, right? I checked the box, but I didn't learn how I could actually be better. And so to me, that was really a wise and insightful thing from the executive director saying, hey, the audit is a tool for us to get better. It's also a control mechanism. It's also a way for them to dig in and make sure that there's not anything happening. However, it really, a perfectly clean audit probably means you've got a crappy auditor, frankly. And like I said, unfortunately in the nonprofit sector, we all want discounted audit fees. So what inevitably happens is CPA firms kind of put their junior accountants on it, or it's the thing that the partner works on late on Friday afternoon. And so the quality of audits and auditors is not always that great. The other thing I'll point out is, Enron and Bernie Madoff, they had clean audits right up to the brink, right? FEGS, which is a social services, or was a social services organization out of New York, had a series of clean audits. And then in the final year, the auditor said, oh, whoops, you're losing $20 million, and they went bankrupt, right? And so, fiscal health and fiscal discipline is really something that needs to be happening weekly, monthly, daily. It's not something that happens once a year. An audit is one piece of a comprehensive system. And so just because you have a clean audit, frankly, it probably means the auditors missed something. And it's definitely a myth in that it doesn't mean you can let your guard down, and it doesn't, relax what happens throughout the rest of the year. I don't know, Pete or Alan, if you've got anything to add to that. You guys have gone through your own, tons of audits.
Yeah, well, this is Pete. Go ahead, Alan.
Oh, I was just going to add to that, Jeff. I think it's really important from a governing board standpoint that they're continuing to evaluate the audit firm, that relationship with the staff on the nonprofit entity. We need to make sure there's the independence there. Are they changing up partners? Are they changing up the audit staff? Are there actually changes in the audit firms? I'm not necessarily a proponent of consistently changing audit firms, but I think you do need to make sure you're taking steps to make sure that independence stays in place.
Yeah, this is Pete. I think you also want to make sure that that people are practicing your internal controls. A long time ago, under one of our old presidents, our treasurer was supposed to be reviewing their expense reports and signing off, and the treasurer got lax, the president got lax, and so I just, I wasn't blowing the whistle or anything, but I was doing what I felt was necessary to make sure we had a strong control there. So I asked the auditors to pay special attention to all the managers' expense reports, and so they reviewed them and they found that his hadn't been signed, so they just wrote that up, pointed out to the board, and then the board said, okay, we need to change that, and so then the treasurer started reviewing the president's expense reports and signing off, and that was the end of that story. But I think so, as financial people, I think it's important if you see a control that's getting maybe a little bit weak, there's some risk there, there's no harm. In fact, I think you have to do, it's your responsibility to point that out to your auditors, to bring it up, so that you can make sure that internal control is strong.
Right. And we also got a comment from one of our attendees saying that, a good auditor will offer suggestions outside the official audit report. So even if it's not in there, they'll offer, you can do this better, you can do that better. So.
Mm-hmm.
Yeah, no, that is absolutely true. And there's a lot of negotiation and discussion that should occur prior to the release of the official report. So I mean, that's a good point.
All right, Pete, next one's for you. Financial leaders have no business playing a role in social media, especially in a nonprofit. This is better left to marketing and communications experts.
Yeah, Mac, I actually agree with that. No, I'm just kidding. Actually, I used to agree with that, and my president about 3 years ago decided that I should start becoming more involved with social media, and I thought he was kind of nuts, but he challenged me to think of ways I could engage in social media. So he said, go ahead and send an email to all of your colleagues and all your financial folks and see what they have to say about that. So I did. I took him up on it. Sent out an email. I said, hey, my boss is looking for me to learn more about social media and to see how, what the role of finance is in social media. So what do you all do? And probably about 90% of them said, well, we just leave that up to marketing. It's not our forte, not something that we should touch. But the ones that did respond to me that were actually doing something with it, I found to be very helpful. And one great example was a nonprofit that had they had a financial topic of the quarter related to their business, and it was actually put on their website, and then there was a link that was mailed out to all their donors and also to their volunteers. And the topic, the topic would be in the subject line of the email. And then there was another nonprofit that would have a featured article in their newsletter that was written by their treasurer. Funny that we're just talking about audits, because they would actually brag about, that they got a clean audit. And still, though, if you're a donor, it makes you happy to know that, that the organization did get a, unqualified, clean opinion. And also your foundations, if they're paying attention to your newsletters too, and it's coming from a volunteer treasurer, it does lend some credibility. So this last year, in fact, I recently started a blog. In fact, my marketing person came to me and said, Pete, you've been working here a long time. Why don't you do a blog about your 28, almost 29 years at United Way? I said, that doesn't sound too exciting, but let me take a while to think about that, because I think I can do something that might be kind of fun. So what I started doing is I started to actually think about some childhood experiences and how that might relate to what our organization does to help people in our community. And I've written 2 blogs so far, and they've actually been fairly successful. One blog got noticed by a local president of a credit union, and they're reaching out to me because he wants to interview me. So the other thing I'm doing is I'm doing this webinar, so that's kind of another form of social media as well. So I think it's finance people, we can play a role in social media and helping, I think, lend credibility to our organization, especially if we can involve some of our volunteers on our finance committee or our treasurer. I think you can always think of interesting ways to use social media to talk about the finances of your organization and make it fun or tell a fun story about it. So,
Jeff and Alan, any insights about getting out from behind our spreadsheets and getting out into doing some networking and even some media for our organizations as financial leaders?
Well, the thing I was going to just say is there is a tremendous emphasis on transparency, and among millennials and younger donors, there's even enhanced need and desire for that level of transparency. And so, I also encourage social media to use that to talk about what's going on financially with the organization. Like, hey, we had this grant, great news. I think obviously most nonprofits, you focus on your programs and your mission, but I think there's a growing number of donors that are also interested in kind of, hey, what's going on financially to support those things. And I think, that communication come from the CFO it makes a ton of sense.
Well, and this is Alan. Within our organization, we place a great emphasis on stewardship, and so I think with social media, that's a great opportunity to present to your donor base and just the community in general the fact that you're being good stewards of the money that they're entrusting you with.
Excellent.
Yep.
Exactly. All right, Alan. Well, since you've spoken up there, we'll just stay with you. From a financial standpoint, all nonprofits are exactly alike. I mean, I'm saying that kind of cheeky because obviously that's a myth, right?
It is a bit. I mean, there's a lot of things we're all subject to certain rules and regulations to retain our 501c3 status. We all have to file 990s. We all serve a mission. We all have, or we should have governing boards. We have general reports that we prepare. But if you look beyond that, just from the revenue foundations alone, a lot of us differ greatly. Some of us are heavily grant funded. Some rely solely on contributed revenue from donors. Some have developed a model which relies on an earned revenue foundation. And a lot of us, we've evolved differently. And then as you start looking at those foundations, and it's particularly important for your management and your governing board to understand this, that it gets more complex. With the grant funding, it's often temporary in nature. It's restricted to a specific purpose, possibly a specific time. It doesn't even necessarily pay all of your expenses. Those indirect costs a lot of us are familiar with that aren't covered in the grants. Those are excluded. And so with that funding method, a lot of times those entities are constantly evolving to address the particular grants that they're using right at the time. Then you have that contributed or donated funding, and that relies a lot more on volunteer participation to have any type of consistent results. And those funds might come with restrictions. They might not. There may be a length of time related to their use, and there may not. And then you get into that earned revenue situation where basically that funding model, you have fee revenue that you're earning through offering goods and services. And I think that model you have to be particularly careful with because it can often mirror for-profit entities. And so you have to be very cautious and make sure that you're differentiating your organization from a for-profit entity to make sure that you protect your nonprofit status. And then there's a lot of us that are hybrids. We're a combination of those. Like in our case, we partner with the YWCA here in Spokane, and they operate on a very grant-specific model. We operate more on a contributed and earned revenue model. And so it's been important for us from a board standpoint that our boards of both the entities understand how the other operates under those different models so we can have this partnership be successful.
Anybody else want to talk on that point?
I think, Alan, you explained that very well.
He knocked it out of the ballpark. So I want to remind everybody on the call today that you might not have a question about some of the material we're covering, but you do have two financial leaders at nonprofits, and Jeff's organization works with lots of nonprofits. So if you have something that it's just a general question you'd like somebody to address that may not be exactly one of the slides we're covering, please feel free to shoot that to the questions box, and we'll have these guys, we'll shoot them something they didn't prepare for and just see how good they think on their feet this morning. Next up, we're going to go back to Jeff. Annual budgets and comprehensive monthly reports are essential for good management practices within a nonprofit. You got to have those reports timely and strictly periodically. How's that work for you, Jeff?
Yeah, so again, I think this is a long-held practice in both nonprofits and the corporate world, and so there's some semblance of truth to this, but we're actually finding that it's not actually necessary, particularly the annual budgeting process. I will say that it depends on your organization, the maturity of your organization, depends on what your donors will ask you for. Almost all still ask for annual budgets, particularly for grants. That said, from a management perspective, what we've found, generally what happens is you do an annual budget and you wrap it up in March of the year you're supposed to be doing. So you're already 3 months into the budget. So it's remarkably accurate for the first 3 months, maybe even the first 6 months. And then you start deviating from the budget in the third and fourth quarter, and everyone kind of rolls their eyes and goes, well, that's because, we were farther away, right? So it's very difficult to predict what's going to happen 12 months from now. One of the other traps of the annual budget is revenue tends to be uncertain, right? And the expenses you commit to tend to be certain. And so you just have a fundamental trick in that you plan on X revenue, you commit to those expenses to support that, and then that revenue comes in short, typically. Maybe occasionally there's somewhere it comes in high, but that's rare. So that's a fundamental trap that organizations can fall into. And so what we advocate for is really like a rolling 12-month process. So you're just continually looking forward and anticipating what's going to happen. The other thing that we encourage is for the revenue that is uncertain, right? And if you're a school in the summer, you know your revenue basically for the whole year except for maybe how much the auction's going to bring in, right? But you got your tuition, you know what's happening. But for a lot of organizations, that revenue is uncertain, that we may or may not get this grant, that big donor may or may not write another check. And so what we advocate for is, hey, create a wish list and don't commit to it until the revenue comes in. So then when the revenue comes in, oh, whoops, okay, it's time to reforecast or rebudget because we just got an extra chunk of cash, and now we've already talked about our wish list. So now we're gonna knock off the top 3 things on that wish list, and we're gonna roll out that after-school program, right? So generally where I see organizations get in trouble is they go with the build it and they will come model, and that's particularly tricky when the revenue is uncertain. The part of this myth, which I think is very true, is you really need, we really like having a rhythm of reporting, and whether that's monthly or weekly, depends on the size of your organization, but just kind of having a regular cadence to the reports you get, looking at the same reports over and over and over. Then you're spending less time trying to figure out what the reports mean. By the time you see the same data the 5th, 6th time in a row, you're less trying to figure out how to interpret it, and you're more spending your brain thinking about, okay, what decisions should I make based off of this information? The last thing I'll say on this is the real goal, one of the primary goals of accounting is to help you make better decisions as an organization. And so don't get too tied up in the format. Don't get too tied up in, hey, we've got to, we got to follow GAAP and accruals. From a management reporting standpoint, it may make sense just to look at cash, or it may make sense just to look at a subset of that financial data, and to really think about what throughout the year, what is going to help me make better decisions, and make sure that your finance group is giving you the reports that help you make better decisions. 'Cause to me, that's one of the fundamental purposes and intents behind the data.
Yeah, Jeff, I liked what you were saying there about a wish list, and what you can do. What we've done the last couple of years is used our budgeting process to involve our board members in, okay, how can we raise more money? Because what usually typically happens in a budget process is you put in your wish list, all the management puts in their wish list, and then you go, okay, well, we don't have enough money for this, and so then you cut it. By the time you present it to the board, it's a break-even budget. But what the board never saw was, the wish list had some really great things that could actually advance your mission in there. And so it's great to bring that wish list to the board and say, yep, we are presenting a break-even budget. However, here's another $500,000. If we had this money, we could do X, Y, and Z, and this would help us to further advance our mission. So can you think of ways that you might be able to help us with raising that additional money? So it involves your board in thinking about revenue, which is what they should be thinking about.
Right.
Well, I think those are great points. When we present our budget to our finance committee, we actually have what we refer to as contingency plans built into those. So within each of the department budgets, they have a certain component of that wish list, if you will. If things go better than projected, here's the order of things, so to speak. We've already thought about it before the year even starts.
Gotcha. Now, What about, we had one question shoot in about doing forecasting, 6-month forecasting. Can you talk about that a little bit?
Yeah, I'll take that one. That's really, it's kind of what I'm advocating for, is instead of having a very static annual budget that everyone dogmatically sticks to, it's, what we do personally as an organization is we have a rolling 12-month forecast, and the next 6 months are locked, right? So like right now, my budget is locked through March, and come December, we'll reforecast for, March to June and out into the second half of the year, but we'll lock in. So we basically have like 6 months locked, and then we're continually sort of reforecasting the 6 months out. And again, it really depends a lot on the nature of your organization. If you're a school, an annual budget makes a ton of sense, right? Other types of organizations, and depending on how the revenue flows in, you may need to do it more frequently. So my point is just that an annual budget process is not something that has to be dogmatically followed. It really should be tailored to the nature of your own specific organization.
Exactly. Okay, great. Pete, you're up next. If you have a large nonprofit, been around for a while, and have good brand recognition, you can't fail. You're going to last forever. Tell me why that's not true.
Well, actually, Jeff talked about the organization out of New York called the Federation Employment Guidance Service, or FEGS, F-E-G-S, not FIGS, but FEGS. And they were the largest human service provider in New York, $250 million annual budget from what I understand. And then largely they got a lot of their money from city and state grants, but it was a lot of federal pass-through dollars. And, yeah, some critics said, well, it was poor management, it was a bad business plan, they stretched themselves too thin. And part of that may be true, but there's an organization called the Human Services Council, and they've started to study the whole nonprofit industry, and they also looked at FEGS as well. And in the report, they highlighted how precarious the entire nonprofit sector has become. And they see the nonprofit industry is crumbling and that it won't survive without fundamental changes in the way that governments reimburse nonprofits. And then, when you get a government grant sometimes, if you look at all the regulatory burdens and reporting burdens there are, it's I just talked to one of our people here today. She came from another organization that got a government grant, and their program managers are quitting because of the burden of filling out all the necessary required reports, and then the metrics that are really, really hard to actually meet. So they're just pointing out that you really have to be careful when you take on government, especially government contracts and grants. And some things to watch for is, I think most of you, we all know, is that most government grants come with matches. So if you can prepare ahead of time to know where you're going to get your match requirement, that's really smart to do. So you want to make sure that you've got a generous donor on the side that supports that particular grant or that particular program, or you've talked to a foundation or a corporation that's going to be able to support that match, because some matches can be up to 100%. And we applied for one 3 years ago, and I'm glad we didn't get it because we didn't have all the money at the time either raised. I think we would have eventually got there, but it would have put our organization at risk had we had to come up with that entire match. And then another thing is, like Alan was talking about indirect costs earlier, you really want to make sure, even if it's a non-government grant, if you're applying for a foundation, we just applied to a foundation a few months ago, and I put in a 10% indirect cost rate, and they said, well, that's ridiculous. We don't want to pay for any of your indirect costs. And I said, well, then we're not going to do it. We're just not going to do it because we don't have to, first of all, and second of all, unless we can cover all of our costs, we're just not going to do the work. I mean, it was a hospital, and I said to them, would you do something for 20% off or 10% off? And they said, well, of course not. So anyway, you got to be tough, I think, when it comes to covering all your costs. That's a real key, because like FEGS, if you're if you're not covering all your costs, eventually bad things can happen, and you will eventually end up going out of business. And the other thing is, make sure you've got a line of credit unless you're really financially reserved well, because governments are notorious. I'm waiting on a payment from March still. It's a very small federal grant, but what's that, 6 months, and they still haven't paid. So just make sure that you do have some good cash reserves, or you have a line of credit in place if you don't, so that you can cover your general operations until those payments come in. And then the final thing I'll say about this, another thing putting the squeeze on the whole nonprofit sector is, various states, municipalities increasing the minimum wage, and then the DOL's recent move to increase the wage base to pay overtime for salaried employees, and that's coming up on December 1st. So, again, I think all nonprofits have had to relook at their budgets and decide what they're going to do to meet those two types of changes.
Yeah, I noticed. I was going to add on a comment there. There's several comments around, hey, what is a healthy cash reserve? I think the general rule of thumb is if you have 3 to 6 months of cash on hand, and what that means is if you're spending $1 million a month, you need to have like $3 million in cash, or $3 to $6 million in cash. So it's what's your monthly spend, what's your monthly expenses, times 3 to 6 is generally viewed as, hey, that's healthy. Again, it depends on the type of organization and the volatility of your revenue, but that's a general rule of thumb. Would you guys agree with that, Alan, Pete?
Yeah. Yep.
I definitely would.
Yep.
And I think along those lines as well, the nonprofits have to be really careful about taking on too much of a debt level. Is that those debt loads sometimes can, as the revenue streams change, all of a sudden, if you have a fixed level of debt payments, it can just be stifling to the organization.
Yeah.
I would agree. I think 6 months at a minimum is really you want to have at least 6 months. 3 months if you're maybe smaller, and if you can, the sooner you can get to maybe building up a small endowment, like an unrestricted endowment, that would also help as a fallback as well.
Great. Thank you. That was really in-depth. I appreciate that. Alan, the next one's for you. Strong policies are a good thing. How can strong policies be a bad thing?
Well, I think in a lot of cases, strong policies are a good thing. We talked earlier about transparency and the importance of that, and I think sometimes those policies can encourage that transparency. But those policies are only good when your management team or your governing board are following them, continuing to evaluate them, or in cases where they don't follow them, that's when it's really important that they're transparent about why they're not following them. We've had, organizations I think recently are really, really learning the importance of having policies about wire transfers. There's a lot of wire fraud going on, and so those policies requiring certain steps to be taken, that's really helped. But then there's the other portions where we talked about it earlier, some of those policies like the purchasing policies, the check signing policies, those policies that are designed to have internal controls, at some point in time they may be a hindrance to staff and how they're able to do their business. And so that's where it becomes really important that you're evaluating those on a regular basis, working with Jeff and saying, what do these things still make sense? Because sometimes they don't. The answer is no. We need to just throw this one out or totally change it. Then, in the area where you're looking at those policies and you may be deviating from them, if you look at a case of an endowment board, they tend to have pretty strong investment policies. And so if you might have an investment policy that says you're going to invest in, say, 60% equities, 40% fixed income investments on a very consistent basis. All of a sudden that endowment gets $2 million, and you would think, yes, we're going to go ahead and the investment committee is going to direct that to be invested in those right now. But then at the same time, if you look at at our recent financial markets. They're volatile, they're unpredictable, the foreign markets are having a significant short-term effect on things. Sometimes these investment committees right now are talking to investment advisors and saying, now might not be a good time to put that cash into those investments. So here you have a group that's operating against policy, and that's not necessarily a bad thing, but I think that's when it becomes really important to be documenting the decisions that are made, why those decisions are being made, so everyone understands that this was given a lot of thought.
Yeah, and you make some good points. This is Pete. The other thing is to have your policies reviewed regularly. We had some policies that hadn't been reviewed for like over 20 years, and so we have a committee that's looking at all these policies, and actually some of them still apply, but there's some that are so far out of date. So now we're trying to put into to place where different committees will review those policies by their committee and just note to the board, yep, we reviewed these with no changes, or yep, we reviewed these and here's some proposed changes we want to make.
Well, it's been a simple little trick for us, but our communications department got involved with a lot of our policies and how they look and how they're written and the fonts we're using, and they changed the fonts on everything that we have. And so if you see something and it's in the old font, chances are that policy hasn't been reviewed recently, and you need to be taking action. I know it sounds a little ridiculous, but it's really worked.
Oh wow, that's great. So next one's for Pete, but Pete wanted to run a poll first, so I'll go ahead and throw that out to see how many of you, and if guys, if you click on the surveys tab, you'll see the results come in live. And we'll see how many people have certified public accountants on staff. So, and the early results that have closed in about 10 more seconds indicate that most everybody does not have a CPA on staff. We're looking about, actually, I don't think that's a bad number, guys. 30%, maybe 30% have a CPA on staff of our audience.
Mm-hmm. Yeah.
Okay, great. So I'll go ahead and close that survey. So, yeah, the results were about 30-70 CPA versus non-CPA on staff. And fortunately, it seems like everybody knows if they have a CPA on staff, which is good. So, Pete, do you have to have a CPO in the front office? Does a CFO have to be a CPA?
No, I think it's certainly nice, and that's all I'll say. It's certainly nice if you have that person be a CPA, but it's definitely not required. And this is real timely because I was talking with my boss last week, and we were talking about succession planning. And she said we have just a very small organization. There's 3 of us in our finance department, and so she says we don't have another CPA on the staff that's in finance besides you, right, Pete? And I said, yeah, Donna, but that's a myth that you have to have a CPA. And I said, guess what? I'm doing a webinar on this next week. So I said, what you really want to do is, first of all, just make sure you do have somebody that, knows how to prepare financial statements. They're schooled in GAAP, and they know how to work with auditors. They know how to work with volunteers and explain, nonprofit financial information. That's all really, really important. They know how to do forecasting, risk assessment. Make sure they understand insurance laws, that type of thing. But really, the most important thing I said, Donna, as you know, the most important thing is just to have a good leader. And so I put up on this slide here. You'll see some of the characteristics of a good leader. And I'm going to spend just because we're running out of time here. I'm going to talk about the emotional stability, or really what I call emotional intelligence. And this is something I learned about 3 years ago. I think it's one of the most important qualities in a leader is emotional stability, emotional intelligence. And what that means, it's a premise that no matter what leaders do, success depends on how they do it. So it's how they emotionally impact the people around them. So it's what they say, and it's also what they actually do. And then I found a worldwide study of corporations that showed that climate alone, so in other words, leadership at the top, or even, not even at the top, but with your teams, if you exhibit emotional intelligence, and I'll talk about those qualities in just a second, that it actually shows that more companies who have highly skilled leaders with emotional intelligence actually grow their profits and are successful than the ones that aren't. So some of the qualities are self-awareness. They accurately know their own feelings, their preferences, their goals and values. They can sense how others feel. They have like a self-confident, can-do attitude, overcoming self-doubt. And then they really deal well with stress and controlling their emotional moods. And I'll give you an example. We used to have a leader who would come to a staff meeting and say stupid stuff. And then after the staff meeting, us as the rest of the management team would have to do damage control and talk with our staff and say, well, that's just our, leader being a leader. He says stupid stuff from time to time. You just ignore it. But it was very hard because then we didn't look like a coherent management team. And actually there were times when, in those years when he was the leader, that we did suffer, and suffered revenue-wise too, because the employee morale was down. So the emotional stability, the emotional intelligence, if you don't know about emotional leadership, emotional intelligence, go do some research on it. It's pretty interesting stuff, and I highly believe in it. So I would, if I was going to hire someone to be my financial leader, I'd hope that they'd be a CPA, but it certainly wouldn't be something I'd disqualify someone if I knew that they knew their finances and that they were a good leader. So I think just good leadership qualities are really just as important as knowing financial stuff.
Yeah, I would add, Peter, this is Jeff, I would add there are a lot of CPAs who do not understand nonprofit accounting. And nonprofit accounting is another whole level. It's as you guys, as we all know, there's another whole layer of complexity. And so the CPA is, like I said, it's a nice to have, but almost more important is really knowing and understanding the complexity of nonprofit accounting. The other thing I'd add, just from a practical standpoint, a model we see a lot is, one is you have a board member who's a CPA that can help, that's available, or a treasurer or something like that that's available for questions. And the other thing is that I think is probably underutilized is a good auditor, a good audit firm will be happy, and they almost prefer you to ask questions throughout the year. And so you have questions about, hey, how do I treat this particular gift, or we get this fixed asset, whatever. And those are questions that a good auditor will be happy to, chat with you about for 15 minutes if you're just not 100% confident on how to treat it.
Yep, those are good points, Jeff.
Well, and I think going back to the transparency, looking for an individual who's able to communicate with the other management staff and the governing body is more important than that CPA by far.
Yeah. Yep.
Great. All right, so we do have some questions in the queue, and we have a bit of time. So we'll go ahead and start answering some questions with the amount of time we have left. We did have a couple of questions come into the queue about CPE for today's event. There's no CPA for today's webinar, but we do have one next month on FASB's new regulations for reporting standards that does have CPE attached to it. So I'll get that out of the way before we start answering questions. So you can click on the link right there in front of you and go ahead and register for that now if you want to. But we'll go ahead and handle the questions first come, first serve as they came in, guys. If you'll look at your Q&A module in front of you, I'll start with number 4. Is there a standard practice for allocating fundraising staff costs to each specific event? I do see this question a lot about how to deal with events and how you run those through your books.
Yeah, Alan, you might want to answer this one. We don't have a lot of events, but I imagine the Y does.
Yeah, and I think in these cases it does vary. It can vary by the size of the event and the size of the organization. We tend to be a fairly good-sized organization, so in our case, we do allocate each of those expenses directly. We maintain records on what events their individuals are participating in, so we're able to track all of those costs. In a case where you may have a person serving in a lot of different roles, wearing a lot of different hats, that may not make a lot of sense, but you still want to, go back to those, estimates and basically make an educated guess on what you think is the best way to apply those.
Okay. Mm-hmm. Did you want to add anything, Peter? Oh, that's right, Peter.
No, I definitely agree with Alan on that. It sounds very reasonable.
Okay, we'll go on down to number 9. Typically, what percentage of an annual budget should be in the reserve to be considered a stable nonprofit? Did we talk about that one earlier already?
Yeah, we said 3 to 6 months. I think would be preferable. I'd probably be more conservative and say 6, and then if your organization's been around for a while, I think if you can look at an endowment, the sooner you can start like an endowment. That's also a good fallback to have. We have an endowment that started 10 years ago at 0, and now it's almost $4 million. About 90% of it's unrestricted. So we kind of say, okay, yep, we've got our 6-month reserve, and if something really, really bad happened, then we have a second fallback, which would be the unrestricted part of our endowment. And then we even have a third fallback. Fortunately, we have a building and it's all paid for, so we could get a line of credit on that building as well. So the more fallbacks you have, the better.
Great. How about, maybe Jeff can talk a little bit about this one, resources for benchmarking financial performance at a nonprofit. Does anybody have any ideas about that one?
Yeah, there's a handful out there. The kind of the charity watchdogs, if you will, like GuideStar and Charity Navigator. There's a new one called Great Nonprofits that's trying to kind of be the Yelp of the nonprofit sector. They all publish financial metrics. The general issue in the sector is, an environmental advocacy organization is very different than a food bank. And so and it's very different if you're in Boise, Idaho, or if you're in St. Louis. So in general, the benchmarking does not get very granular before it loses its kind of statistical importance. But for some basic metrics around, the one we were just talking about from a reserve standpoint, or what's a typical surplus, or what's a typical percent spent on personnel, those are all things that those organizations publish, and generally on an annual basis. The other source is the Indiana University Center on Philanthropy. They publish some great, statistically, academically researched, and so those are also good spots to get comparative data.
We'll move on down to number 12. At the end of the fiscal year, does any profit or loss get reported as retained earnings or net assets? This is getting kind of granular. Do all nonprofits show retained earnings as a line item on a balance sheet?
I can go ahead and take that.
Okay.
Just the short answer on the profit and loss is you show that as a change in net assets, similar to profit or loss. And then as far as the balance sheet, you then would reflect that as your net assets. And we break those down into the unrestricted, the temporarily restricted, and the permanently restricted net assets.
Mm-hmm.
Okay, 16. Regarding legitimate budget reliving VIC reporting, I'm sorry, I'm not a CPA. Talk about the issues that the Form 990 presents a different picture of a budget year-end versus a fiscal statement. So we're talking about reporting on a 990 and then perhaps a financial statement, how the numbers sometimes don't equal each other or balance out or look the same.
Yeah, there's this is Pete. There's a reconciliation page. So, for instance, like in our nonprofit, we have donor designations. We're not allowed to report those as revenue on our financial statements on our audited financials. And so what we do on the 990, though, the IRS wants to see the entire activities of the organization, and they actually issued a determination letter years ago where we can put the designations as revenue on the 990, but then there's a reconciliation piece where we have to reconcile the 990 back to the audit. So that's how we match up the 990 to the audit using that reconciliation as a required form in the 990.
Well, perfect. Well, guys, that takes us up to the top of the hour. We're out of time. I would like to thank all three of you, Peter, Jeff, and Alan, for participating today, for everybody who's tuned in. Hopefully you'll come back next month. Big topic, important. Will definitely be a little bit wonkier than usual, but it's an important issue to talk about, so we're going to tackle it FASB next month. But, gentlemen, I really appreciate your time. Thank you so much for your efforts.
Thanks, Matt.
Thank you.
All right. Bye-bye.
Have a great day. Bye.
Bye-bye.
Take care.
All right, we're off.